How did you predict the Indian market crash?
Whenever there is excessive greed in the market, it's a time to exit. I was able to gauge from the market pulse, so I thought it's a good time to exit. On the contrary, whenever there is too much in the market, it's a time to enter. The gold dollar an ounce rate was close to $1,600 an ounce. Yesterday it has just $3,000 an ounce, which is almost 80% up. And I see by 2035, I will not be surprised if this gold touches $10,000 an ounce.
So mutual funds at best can give maybe 12 to 15% returns, right? They're bored of mutual funds. So what can they do to sort of get that alpha?
So honestly,
In terms of your ideal asset allocation mix for a retail investor, what is your recommendation?
if you are anywhere between 20 to 30 years old, then I think 60% should go into equity, 20% into gold, and 20% into debt and fixed deposit as a contingency fund.
So now that Nifty is down, now I want to know how should I invest my money in today's India?
So honestly,
As of today, the Indian market has crashed by almost 16%. And this man predicted it before everybody else. He is Mr. Amit Jain, co-founder of Ashika Global Family Services. He is someone who manages billions of dollars for some of the richest people in India. And I'm absolutely privileged, sir, to be talking to you today.
thank you, Sharan. Thanks for having me on the show.
So Amit, let's start off right off the bat. I want to know, how did you predict the Indian market crash? What is it, 6 months before everybody else?
Yeah, on 8 September 2024.
Right, you said it on Money Control, and I was just going through that article. How did you do it?
So honestly, I strongly believe that market moves only on two factors. Number one, greed, and second is fear. Whenever there is excessive greed in the market, it's a time to exit. And in September 2024, I was able to gauge from the market pulse that there's too much of greed in the market. Even after market has at least 20%, 30% in a year, people were expecting another 20% rise in the Nifty. So I thought it's a good time to exit. On the contrary, whenever there's too much of fear in the market, it's a time to enter. And we entered last week.
What is that data point that you look at? Because you said that there was so much greed 6 months back. So what is the data point that you look at after which you will be like, oh, there's too much greed?
So number one, the valuation, the relative valuation of the equities versus any other asset class in the world. So for example, in September 2024, when we preempted this exit point, the Nasdaq was trading at a P multiple of almost 33, right?
Okay.
Which is an earning yield of 2.9%,
Okay.
versus a Nifty yield of say 4%.
Now, when you mean yield, what do you mean by that?
So whenever you say the earning yield is how much I make in percentage term if I invest 100 rupees into it.
Okay.
For example, if the P is 33, earning yield is always 1 divided by PE. So my earning yield is close to 2.9%.
So 1 divided by 33 into 100.
100. So it's close to 2.9% roughly.
Okay.
Right? While I'll go to Nifty. Nifty was trading at a PE of almost 24, 25, which was an earning yield of 4%. So I have to be sane, or I have to be insane, I'll rather say, that to invest into Nifty at that valuation. Because US government, on the other hand, on the third party, so generally equities are compared with the debt because you have only 3 or 4 asset class in the world. Either you invest into equities, you invest into bonds, which is government bonds and corporate papers, or you invest into gold. Or fourth is real estate, right? We try to figure out that how is the valuation across the asset class across the world. First, you have to compare all the asset class, right? So example, equities has been overvalued for a very long time after COVID. So first of all, we had adopted a little conservative approach on the equities as an asset class because that looks very overvalued to us compared to their historical valuations.
Okay.
Number two, bonds, which were giving us, I'll talk about the US bonds, which were giving us an earning yield of say 1% 3 years back, right? They are giving me an earning yield of 4.6% today.
Which is more than the markets.
Market, absolutely. So equity is giving me earning yield of 2.9% and US GSEC is giving me earning yield of 4.6%. So of course, if I'm a sane investor, I'm going to shift from equities to debt because debt comes with a lot of safety. It gives me a fixed return over a longer period of time. And US Treasury has been the safest asset class in the world.
So, but why did nobody else see this? Like, I'm sure there are a lot of other people also who calculate these yields and all of that and compare asset classes across the world. But what were our mutual fund managers doing when this was happening? Why did they not see this?
So honestly, I'm sure they must have realized it. But at times when you are a mutual fund manager, you're not a family office or you don't have a prop book, I think you have only one option to remain long because the people give money to a fund manager to invest, not to sit on the cash. So it's more a compulsion rather than a choice.
Got it.
So and mutual fund, generally people invest for a longer term. And in longer term, India has been the best market in the world. I don't know if you are aware of. If you take out the history of last 25 years, Indian stock market has outperformed every stock market in the world in dollar terms.
Oh wow! Even though the Indian rupee has dropped by 80% compared to the dollar, Indian companies have still grown so fast that it is still the best performing stock compared to any other country in the world.
In last 25 years.
Wow. So now let's go. I was just doing more research about you. You were the first one in 12th July 2020 to say that gold is a bazooka.
Yeah.
Right? And since then, from 2020 to today, gold has given 80% returns. And you said that in 2020. And only now people are talking about gold. How did you predict that?
So honestly, when I said it, because that was a COVID time, I thought if COVID is a man-made disaster, as the people say that it's a China virus, it's a Wuhan virus,
right,
or it's someone else has created it.
Right.
So if it is man-made virus, I'm sure the ulterior motive of creating this virus will unfold with time. And that ulterior motive had been the deglobalization. Because the world is fed up with the US dollar and the US Fed policy because they can print money whenever they feel they want to print money. I don't know if you are aware of that in COVID times, the US Fed has printed $4 trillion in 6 months.
Wow.
You know how much money is that? That they have created another India in
by
6
printing.
months. Only by printing in 6 months.
Wow.
India took 80 years after independence to build that level of GDP. US Fed is a free printing machine for the dollar. And that's where people wanted to get out of US dollar because they are, for example, if I import something or I export something to US, I'm giving some goods and services in exchange of US dollar. And that US dollar is freely printable. Are you going to value that currency?
Can we blame the US for the inflation in India right now?
Absolutely. The entire world for that matter. Because till the time this petrodollar continues, you will find the imported inflation for all the developing nations in the world.
What do you say? Petrodollar?
Petrodollar. So petrodollar is that treaty is being signed by US government and Saudi Arabia.
Okay.
That anyone who is going to buy the oil from the Saudi Arabia, they have to make a mandatory payment in the terms of US dollar.
And they've signed it.
They have signed it in 1971. Even that treaty got expired. And that's where there's a whispering in the market that petrodollar will be replaced by petro yuan going forward. And there is a math behind it. Because today, China import 35 to 40% of their oil from Saudi Arabia. And once I have a business transaction with one country, then of course I'll respect that country with whom I have a business transaction rather than respecting someone else. And China is equally strong in terms of army today. They can also give them the equal amount of protection what US offered in 1971. So there's a whispering. I don't know if it happened or it doesn't happen.
But why is US doing it? Why are they printing so much?
Because this is the only country in the world which is into fiscal deficit for last 20 years, except 1 or 2 or 3 years. They're into fiscal deficit and still they are the reserve currency of the world. And the world has given them a power in 1944 with Bretton Woods Agreement. So there's a long back history to the US after World War II. And in fact, they become the reserve currency of the world after World War II. And they will end only after World War III.
So meaning winning World War has a lot of benefits for 50, 60 years.
Absolutely. You can orchestrate the world the way you want it to be.
Yeah.
And that's what they did. So that's where probably I said that gold is next bazooka. Because if the gold-backed currencies come back, then every country, every government is going to buy gold left, right and center. And that's what happened after 2020.
I think you've kind of answered my next question to you. Because now I'm starting to understand how you actually preempted World War III, right? So please answer it. Like you preempted World War III. You mentioned about this in media articles that World War III is very imminent before, all of this happened. So is that answer related to this, that you saw some tension?
So half answers started post COVID-19 when the world has seen that they have printed so much of money. But the first answer started with 2008 crisis. When some handful investment banker from the US has orchestrated the entire global financial crisis for the world. Why I am sitting in India, I'm sitting in China, I'm sitting in Russia, why I should be penalized for
US
someone's
printing.
mistake in US, who wanted to get a huge bonus, and they have created a subprime crisis for the world. Till 2008, world was unipolar. It was under the leadership of United States of America. But after this global financial crisis in 2008, the economies like Russia, China, and other emerging economies start evaluating other options, that how they can surpass dollar in terms of their trade. So the founding stone of deglobalized world started in 2008, but it was further aggravated post-COVID to COVID-19 fiasco.
So wait, so first it was started by Putin in Russia, right? He attacked Ukraine, but a lot of people will think of it like, why is Russia all of a sudden causing, war? Everything was fine, everything is in peace, right? But the story is right now much more bigger than what we actually think, right? There is a lot of history behind, these sort of decisions. Nobody just simply goes out there and starts killing people. When they feel like their country is getting poorer because of some other nation halfway around the world, the country's leadership has to do something, and this is what we are seeing right now.
Absolutely, you're right.
And you also personally have met Putin, right?
Yeah, we have an interaction. It was amazing. He's an amazing
How is he?
guy.
People look at him as a dangerous person. How is
So
he?
I found it to be very evolved. I think when I interacted, I listened to him in that St. Petersburg International Economic Forum. He knows economics very, very well. When I listened to his thoughts, I think whatever moves he's taking, he's well planned in terms of all the repercussion, what is going to happen in Russia, whether economically, financially, or in the power equation of the world.
I think once you start of understanding economy and start understanding how the world is working in terms of exchange of currency and all of that, you start realizing that everybody is doing what's right for their country.
Absolutely, right. Absolutely.
But Amit, your preemptions and all are fine. But something which I did not like is that you made almost 103% returns in 1 year, less than 1 year, by investing in China.
Yeah.
Right? Now, that sort of, I'm thinking, are you really a Deshbhakt, right? Because you're in India. Why are you not investing in the Indian market? Why are you investing in China? I mean, India doesn't like China. We are always, fighting with each other. So how do you explain yourself?
So honestly, my version of story would be that we don't fight with China, we compete with China. And so we invested China in on 28th March 2024 in something called Hang Seng ETF, which are listed on Indian browsers. So trust me, I am equally a Deshbhakt like you and everyone who's listening to this podcast. So I did not go and invest into China. I only bought the ETF of Chinese technology sector, which are listed in Indian stock market browsers. So the fees is made by Indian broker only in that case.
Okay.
Right? So
that's your excuse.
Yeah. But we made a huge money because we found a great value proposition in investing into China's tech sector. I'll give you a comparison. When we took that decision, I think Chinese tech sector was trading at a PE valuation of 7.
Okay. And compared to historical of?
And compared to NASDAQ, which was trading at a PE of 28.
Okay.
That moment of time, right? So there was too much of fear in the Chinese market. The biggest investor of the world was selling this Chinese market. And we thought it's a great opportunity. We are finding a competitive valuation, which is almost 75% discount to the NASDAQ. And we thought it's a great opportunity. And we took a contra bet and we made 102% return in that ETF.
Year. So basically you doubled your money in less than 1 year.
Yeah, 11 months precisely.
Right?
Yeah.
So when you take these sort of contrarian bets, I would love to know, how do you sort of decide how much % of your money will sort of, invest in sort of a thesis that you have? For example, we just talked about the investing in the Chinese market. So, okay, you did this analysis, their relative valuation compared to the US was much more favorable to you. So let's say you have 100 crores. Do you straight away put all 100 crores there? Or how would you decide?
No, so it all depends at what value proposition and what is the liquidity in the underlying assets. So ETFs generally will not have that amount of liquidity that I can put 100 crores into it, right? So we figured out our right allocation in that particular asset class.
But let us say my whole net worth is 1 crore.
Yeah.
Right? Now, let's say I was also as smart as you. I realized that this China market is so undervalued. Let me invest. Now, as a retail investor, if I have 1 crore of savings, how much should I take a bet on this opportunity that I have?
As a retail investor, where I see that I am finding a compelling valuation in a market like China, first of all, you need to have a conviction in China. I had that conviction right from day one.
Yeah.
So based on that, I think we figured out that China is a good story. And if you have the same amount of conviction, what we had in China, then you could have invested it. Else, I think there's a lot of other options for the retail investors. And I think retail investors should generally go through a mutual fund route. Because what happened in stock market, the most important aspect is not the stock. It is what price you entered and what time you exit.
You're right.
That matters. So stock market investment is only about 3 things. Number 1, right timings. Number 2, right pricing. And number 3 is right allocation, as you just said. If you have a right combination of all these 3, you are here for a good ride. But a retail investor who is into 9 to 5 job, who is not dedicated for this kind of job, I think it's better that they outsource this activity to a fund manager who do it 24/7 for them.
No, but like, because today if you talk to a retail investor in India, and if you ask them what is that returns that will make you happy, everybody will be like 20-25% is what they want. Now mutual funds at best can give maybe 12 to 15% returns, right? FDs, you forget, it's giving 6 to 7% returns. So people want that extra, right? They're bored of mutual funds. They want like something more. So what can they do to sort of get that alpha?
So honestly, for me, if a retail investor want to take a bet directly into a stock market, then they should not dabble beyond Nifty 200 stocks.
Okay.
Because there are very high chances they will get into a wrong stock at the wrong time. And the biggest mistake with a retail investor do, that their passive investment strategy.
Okay.
We have a number of examples. We keep talking about Bajaj Finance, but no one talks about HDFC Bank. IDBI Bank price was 40 rupees and ICICI Bank price was 4 rupees in 2099, around that time frame. Today, ICICI Bank has moved from 4 rupees to 1300 rupees.
Okay.
And IDBI Bank has moved from 40 to 80.
Okay.
If you stuck up passively in a wrong stock for a longer period of time, you will destroy your wealth. So stock picking is equally important. I'll always suggest that allow the fund manager to do it who's professional, who knows in and out of it.
Right.
If you are willing to take that risk, of course, look for good stock in Nifty 200 itself. Because in Nifty 200, you will find a lot of mispricing.
Until the mid-cap sector.
Nifty 200, to an extent mid-cap, large cap, giant cap, and to an extent mid-cap, a higher amount of mid-cap. So in that space, you will find a lot of mispriced stocks. You can invest in those stocks.
What do you mean by mispriced for the audience?
So for example, even at today's valuation, I find a large petrochem company, which is highly undervalued compared to its fundamentals.
Okay.
But, and that's what I said, mispricing. At times, market misprice in the shorter term, right? If someone invests in that company now,
when you mean undervalued, that the intrinsic value of that company
is much higher.
Is much higher than the stock price.
Stock price, one, and also it is trading much cheaper compared to its traditional valuations. And the growth potential. It's
finding this out, is it easy or difficult to find out companies
if you find out within Nifty 200, you will find a lot of companies you can find out.
Easy,
and
right?
And you can play with this mispricing of the stocks till the time they get perfectly priced.
Do you have any data on 20 years back, whatever companies there in Nifty 50, how much percentage of them are not there anymore in Nifty 50?
That's what I said. So that's the philosophy we follow, and we call the 9th wonder of the world, called invest rightly, switch timely. I can build on it slowly, but you have asked me a very specific question related to stock market, so I'll answer it.
Yeah.
So I remember in 1987 or 88, Sensex has 30 stocks.
Okay.
And out of those 30 stocks, only 6 still exist. 24 are switched out by Sensex itself.
Because they have not grown fast
They have not performed. If they would have kept the same companies during this 30-year tenure, the return would not be more than 4 to 5%, right? So that's where switch timely works. And Sensex do it, every economy do it, every corporate house do it.
Even FII does it.
Everyone do that.
That's the reason why FII is leaving India thinking it was overvalued, so they left.
And
so
they're getting into US GSEC, which is giving them 4.6% return. if I'm I'm a manager based out of US, I'm managing $1 trillion of wealth, right? I'm getting 4.6% in my home country risk-free return.
Like an FD of their country.
Yeah, and US Treasury is the safest bond you can have in the
World.
It is not emerging market bond or Brazilian bond, where I can question what will happen
it's
to
the largest economy of the
largest economy
world.
of the world, right? So I'm getting 4.6% into the safest asset class in the world. What is my motivation to go beyond US? For example, so 4.6% is my basic return, which I'm getting in my home country. Plus, if I come to India, I have a risk of 4 to 5% currency depreciation every year.
Because US dollar appreciates against the rupee by 4 to 5% every year.
So I'll say 4.5 and 4.5 to ballpark figure. So 9% return has to be there.
Correct.
Right? 2% is your short-term capital gain. So 11%. Right?
Right.
And at least when I'm getting out of my home country and my home comfort, I want at least 6-7% alpha from my home country. So unless as a fund manager, I make 17 to 18% return in Indian stock market, I'll not come to it. And that is the reason since that point, when I give that interview to Money Control, FIS has sold almost 3 lakh crore of Indian equities. I said 3 lakh crore of Indian equities they have sold off.
That's a lot of money.
That's a lot of money, right? Yeah. Because they thought that at 26,000 Nifty, they will not be able to make 18% return on sustainable basis. And they exited India.
Now I want to know, how should I invest my money in today's India? Is the Indian stock market dead for the upcoming years? What is your opinion? So
honestly, Indian stock market, as I said, is the best performing market in the world for last 25 years.
That's the past.
Yeah. India has another 5 to 8 years where Indian stock market will continue to outperform the world.
Why
and we have reasons for it. We have 3 Ds. What I always say, 3D theory.
3D theory.
3D theory, right? So India has 3 Ds. Which are, and this combination of this 3 Ds is you will not find anywhere in the world. And that's what we call TINA factor. And TINA is, there is no alternative to India. TINA. Yeah, there is no alternative.
So
that's called TINA.
What is the 3 Ds?
3 Ds. Number 1, demand. India is the only country where you can sell a shirt or anything. So example, a shirt, for example, you can sell a shirt for a $10 and you can also sell a shirt for $1,000 and you will find a buyer for both. Number 1 D. Number 2, India has a demographic dividend. Even today, 70% of your population is below 40 years of age. So they are contributing to the economy. This is D number 2. Now, 3rd D is the most important D for us. We are a democratic setup. So as I said that US and the Western world are good in printing money. That's what they know. And we have given them a power to print money, right? But whatever amount of money they print, they are going to only invest in a democratic setup of the country in some form. They are not going to invest into China. We have seen how China and Russia are having a dogfight every day, right? They are not going to put into Iran or the Gulf countries because they are the dying economies of the world unless they revive the tourism for their survival, right? So if for a minute, if I believe you are a fund manager, a global fund manager, what all options do you have in the world? If US has printed $4 trillion in 6 months, that money is going to come into stock market some way, directly or indirectly. Later or sooner, it is going to park its own way because money has a tendency to chase growth.
Correct.
And growth lies in
India.
That's where it is. So these combination of these 3, the demand, your demographic dividend, and your democratic setup. So India is the only option where we have these 3D along with the growth.
So basically what you're saying is that we can still continue investing in India.
At least 5 to 7, 8 years for sure, till the time this demographic dividend turns out to be a demographic nightmare for us, when these population will become a dependent on us. They become older.
Right.
That's what the China is facing nowadays.
Japan faced it for a very long time.
Japan faced it for a very long time. Absolutely. So Japan stock market is in recession for the last 30 years. What peaked, they touched in 1989. Can you guess what they touched in 1989 as a Sensex level? If I take Japan's Nikkei as a Sensex, they touched 40,000 in 1989. In 36 years, again they are 38,000 only.
Would have not changed at all.
That's what I said.
So what do the fund managers do there? Where are they investing?
So they are investing completely into US, and they become the funder for the world. So all prop up, all the equity market you are seeing in the world, I think the Japan is the biggest investor into US treasuries. They are the largest.
So all the citizens of Japan are investing outside Japan because there is no point investing in the country.
Absolutely.
Interesting. So now in terms of your ideal asset allocation mix for a retail investor, what is your recommendation?
So for retail investor, I feel that ideally they should go for a mutual fund route. Even if it is a crore, I think it all depends on your age and goals. But if you are anywhere between 20 to 30 years old, 20 to 25 or 30 years of age, then I think 60% should go into equities, 20% into gold, and 20% into your debt and fixed deposit as a contingency fund, which you can liquidate over a period of time.
What about real estate you didn't mention?
I think that of course is a good asset class, but real estate in India at this moment of time when you're interviewing me, I think it's lifetime high.
Yeah. Now within equity, can you break it down? How much should be inside India, outside India?
I think India should be good enough because full India, because I think a crore rupee should be good enough in India because you can divide it in a way. Say 60% equity, you can put 40% into some mutual fund, and 20% you get into a good nifty stocks, 3 or 4 good nifty stocks, which are currently undervalued.
So directly buying stocks,
absolutely,
which are undervalued based on your own research.
That you can create an alpha on your overall portfolio.
Now let's go one level higher. I know it's still not high enough for you, but one level higher. We'll come to your level soon. Yeah. One level higher is 10 crores.
Yeah.
For someone having 10 crores, how should they invest? Does anything change, first of all, according to you?
So honestly, 1 crore and 10 crore, the philosophy changes. When someone with a 1 crore portfolio approaches, he say, "मुझे तो double करना है." This mindset is completely different. When someone with 10 crore comes, he'll say, "I'm okay with 20-25% okay."
So 10 crores can you tell the ideal asset allocation
So
mix?
ideally it should be, I think I can say that 60% completely into mutual fund, 20% into direct equities, and 20% into gold. He can get away with the bond part, part of it. Yeah, absolutely. Because gold is as equivalent as that is. Because that can be freely, because he will not need a contingency fund.
So you're
for a crore guy,
for
a crore guy, you need a contingency fund. If some medical emergency comes, what will happen overnight? But for a 10 crore guy, you don't need that contingency fund.
So you're saying 80% of it can go into risky assets?
Absolutely. Riskier assets, I say in a combination of mutual fund and large cap stocks.
Got it.
That way.
Now let's go to the 100 crore. 100 crore, how should he invest?
60% should be into mutual fund. Even in that 60%, you can divide that how much should go into thematic mutual funds, which are based on particular theme or a particular sector where we feel we are bullish on. We can take that extra bet and return and generate an alpha on overall portfolio. So 60% should be in mutual fund. I'll say 20% into direct equities. Again, nifty stocks for them as well because they are the most risk averse guy on the earth who has 100 crore. They want safety first.
Correct.
And 20% into gold because gold is here for a long ride. When I said gold, when we said gold is next bazooka in 2020, the gold dollar an ounce rate was close to $1,600 an ounce, $1,600, $1,700. Now, yesterday it has just $3,000 an ounce, which is almost 80% up. And I see by 2035, this gold, I will not be surprised if this gold touches $10,000 an ounce.
Wow.
Because this is a complete hedge against the US dollar.
Okay. So wait, can we deep dive into that 60% you said equity and you talked about thematic?
Yeah.
How much should be into thematic?
I think thematic out of 60%, 30% should be thematic with safe bets because I think, say example, I can talk of sectors. Say we like banking, which is the safest asset class, at least from an India perspective. Indian banks are the safest banks in the world. Trust me. Because I don't know if you're aware of, in last 20 years, post financial crisis, or even after 2007, I can say so, there's almost 600 banks got bankrupt in US alone. In India, I hardly see any small cooperative banks. A Yes Bank incident, which was also overcome by the government, right?
Yes.
So,
one is banking.
Banking sector, 30% thematic fund, and I think 20% you get into FMCG sector. That sector looks very good and compelling buy to us. And we are looking for only those asset class where we see a limited downside risk at current levels. Because even today, when I'm talking to you, we are extremely cautious on US market. And I'm sure you have gone through a note on 1st January 2025, where we said that the way we preempted the exit from Indian stock market on 8th September 2024.
Yeah, I was a witness to this prediction.
And we preempted the exit from US market as well on 1st January 2025. And since then, Nasdaq is down almost 16%.
Like the first time we met was before the markets had crashed in the US.
Yeah.
And then I think a month later when we met, the market had already corrected. And you had told me that before.
And I sent you a couple of screenshots as well on that friendly gesture. So we try to preempt. So I think we are still cautious on US stock market. So we'll say that any investment at this moment of time has to be staggered in a staggered way. Because unless the US market down cycle completes, Indian stock market down cycle will not complete. So we have to, whatever amount of money we want to invest, it has to be in a staggered way in next 6 months time.
So you can sit on cash.
Yeah, you can sit on cash for sure, or you can invest into gold because gold is equivalent to cash.
And any particular industry or sector or market cap that you're mostly focused on?
So I think thematically we are finding a lot of comfort in valuation for banking, FMCG at current valuation, and mostly into giant cap and large, I'll say large caps.
Let's go to the final level, which is your level.
Yeah.
1,000 crores. How to invest? What changes from 100 crore guy to 1,000 crore guy?
I think 100 and 1,000 crore are mostly the same mindset.
Because I was typically thinking that, see, if I have 100 crores, obviously I will be like, okay, I have to save it because it's 100 crores.
Yeah.
But if I have 1,000 crores, I'll be like, I'll never be able to spend all this money. Impossible. Whether I have 500 crore, 600 crore, 300 crore, it makes no difference in my life. So why can't I keep 100 crore safe or at least 500 crore safe, and with the remaining 500 crores just go very, very aggressive?
It doesn't happen that way, because once you earn and wealth.
That's why I don't have 1,000
crores. So once you earn the wealth and you build wealth in your lifetime, you're very possessive about it. And generally the people who have 100 crores, they are already above 55 and 60. So by that age, your mindset also become very conservative.
And the 1,000 crore person?
So again, the age may differ from 55 to 60.
Cool, Amit. I think now let's get to the fun part of the discussion. Obviously, this was fun and knowledge. But I want to ask you 5 rapid fire questions. Are you ready?
Yeah, I'm ready.
All right. If you had to put 100% of your money in just one asset class for the next 10 years, what would it be?
Indian equities.
Indian equities. Very specific. Yeah. What's the one investment mistake that even smart investors keep making?
They don't exit on time.
If India is the most undervalued stock in the world, what is the most overvalued one?
US.
Really?
Yeah.
If you could go back in time and give your 25-year-old self one investing tip, what would it be?
Invest in equities in the right time.
Okay, so one last question.
Yeah.
Which gives you a bigger adrenaline rush?
Yeah.
Getting a 10x return on your investment or predicting a market crash before everybody else?
Predict the market crash before everyone else.
Absolutely. So I think, Amit, one day when I have 100 crores, I will become your client. But until then, thank you so much.
Pleasure, Sharan. Thanks for having me on the show. Thank you. Appreciate it.
All right, guys. Thank you so much for watching till the end. And I'll see you in the next one.